What would you do if $1 trillion, 0 cents, disappeared overnight? No warning, no leaks, no time to react. That's exactly what just happened, and Wall Street is in freefall. In a move that stunned the global markets, China has abruptly cut off all major investment flows into the United States, sending shockwaves through the financial world. Billions pulled, stocks crashing, the bond market trembling. And behind closed doors, U.S. officials are scrambling to understand what just hit them. Today we break it all down, the decision, the damage, and what comes next. China didn't fire missiles. It didn't issue threats. Instead, it pulled a lever far more devastating: money. In a sweeping financial directive issued by Chinese Ministry of Finance and the People's Bank of China, all outbound investments into the United States have been halted immediately. That includes government-backed capital, private equity, real estate buyers, sovereign wealth funds, and even indirect investment through subsidiaries in Hong Kong or Singapore. Visual: Chinese press conference with red banner headlines, "Outbound capital freeze." The order is clear: no new investments in U.S. markets. Existing investments, either paused, liquidated, or redirected to strategic allied markets, which insiders say includes Africa, the Middle East, and BRICS-friendly economies. Why now? Many believe this is direct retaliation against Washington's latest move, a package of economic sanctions targeting Chinese AI companies and semiconductor firms, along with a sweeping ban on advanced chip exports. Beijing saw this not just as a policy shift, but as an economic threat to its future. So it struck back, financially. According to Bloomberg estimates, over $1,200 billion, 0 cents, in Chinese capital was flowing through U.S. markets, buying up property, tech stocks, infrastructure shares, and even farmland. All of that now faces sudden withdrawal or total freeze. Even more alarming, sources say China is now reviewing its U.S. Treasury holdings, potentially planning to dump hundreds of billions in American debt. If that happens, interest rates in the U.S. could skyrocket, and the dollar's global dominance could start to crack. Visual: graph showing Chinese investment decline and Treasury holdings under review. This isn't just capital control, this is financial warfare with precision targeting. And it's not only aimed at Wall Street, it's meant to send a signal across the world. China will no longer tolerate economic containment without hitting back. As news of Chinese investment freeze hit global headlines, the reaction on Wall Street was immediate and brutal. Visual: CNBC ticker in red, traders on phones, screens showing rapid drops. Within hours, the Dow Jones Industrial Average plunged over 900 points, the Nasdaq fell nearly 4%, and the S&P 500 saw its worst single-day drop in over a year. The sell-off was led by companies most exposed to Chinese capital. Apple, Tesla, BlackRock, Goldman Sachs, all of them tanked. Apple alone lost over $80 billion, 0 cents, in market value in just 48 hours, as fears spread that China would retaliate further by restricting its consumer market or supply chain access. Behind the scenes, it was even uglier. Private equity firms like Blackstone saw Chinese investors pull out of multi-billion-dollar projects. Real estate deals in San Francisco, New York, and Miami collapsed overnight. Chinese-backed tech investments, once a steady source of venture capital in Silicon Valley, dried up completely. Visual: stock tickers falling, red charts, headlines like "Capital Exodus." The ripple effect didn't stop there. U.S. Treasury yields spiked amid whispers that Beijing could begin dumping bonds that would flood the market, drive down bond prices, and push borrowing costs higher. The Fed, already struggling with inflation, now faces a new dilemma: stabilize interest rates while bracing for a potential foreign liquidation of American debt. And while the billionaires may have more padding, ordinary investors are already feeling the pain. 401k are shrinking, tech portfolios are bleeding, and hedge fund managers, once confident in China's cooperation, are now scrambling to rebalance entire strategies. Narrator tone intensifies. Wall Street wasn't just blindsided, it was humiliated. For decades, U.S. markets assumed China needed them, that Chinese money would keep flowing no matter the politics. But that illusion has shattered, and now America's financial center finds itself staring into a chasm of uncertainty. This isn't just a market correction. It's a strategic strike that Wall Street never saw coming. The shockwaves from China's financial cutoff didn't stop at Wall Street, and the entire global economy is feeling the tremors. Within 24 hours of Beijing's announcement, Japan's Nikkei dropped 600 points, the London Stock Exchange lost over $250 billion, 0 cents in value, and emerging markets from Brazil to South Korea saw capital outflows accelerate. Visual world map showing market declines, Bloomberg headlines flashing. Countries heavily reliant on U.S.-China trade, like Germany, Australia, and Mexico, are facing dual threats: supply chain disruptions and investor flight. Their stock markets are slipping, currencies weakening, and bond markets turning volatile. Even Middle Eastern sovereign funds, which had partnered with both Chinese and U.S. firms for mega infrastructure and energy projects, are now caught in limbo. Deals are paused, contracts are being renegotiated. Everyone's asking the same question: who's safe in this new economic war? Meanwhile, in the digital space, Bitcoin surged past $70,000, 0 cents, as nervous investors looked for a safe haven. But even crypto isn't immune. Volatility is rising and regulatory pressure is growing as global financial authorities try to maintain stability. Narrator, tone sharpens. This isn't just a U.S.-China conflict anymore. It's a global economic fault line, and every nation tied to the dollar, the yuan, or the flow of capital between the two is now standing on shaky ground. The message from Beijing was clear: if you choose sides, expect consequences. And for the rest of the world, those consequences are already being felt in balance sheets, in stock indexes, and in the uncertainty gripping every major financial hub on the planet. As Wall Street scrambles and global markets wobble, one question dominates every boardroom and war room. What's next? Will the U.S. retaliate with a new wave of financial sanctions? Will China escalate by selling off its $800 billion, 0 cents in U.S. treasuries? Or are we on the verge of something even more dangerous, a full-scale economic decoupling? Visual, U.S. Treasury Building, White House Situation Room, China's central bank. Inside Washington, emergency meetings are already underway. Options on the table reportedly include freezing Chinese assets in the U.S., blocking Chinese IPOs, and restricting SWIFT access for certain Chinese banks, an extreme move that would trigger global banking chaos. Meanwhile, Beijing is playing its next move close to the chest, but state media is already talking about yuan supremacy and accelerating trade in non-dollar currencies with the global south. This moment could mark the end of the global economic order as we've known it for decades, where the US dollar ruled and China played along. Narrator, tone deepens. But now, China isn't just rising, it's resisting. And America's economic dominance, from Wall Street to the bond market, is facing its toughest test in a generation. Will cooler heads prevail, or will financial warfare spiral into something far worse? Because when money becomes the battlefield, no one walks away without scars. Stay tuned. The world economy just crossed a line, and there's no turning back.